Good day. This is the Eye of the Storm podcast with the big picture update for Saturday, April 1st, 2023. Tonight, I will update the SPX cash market for the S&P, the NDX, which is the cash market for the Nasdaq 100, the 30-year bond, the 10, 5, and 2-year notes, gold and silver, plus the dollar index. Beginning with the equities, so the SPX and the NDX, last week was a pretty crazy week, highlighted by daily expirations and a lot of volatility price-wise, coupled with the 31st being the quarterly expiration, which is a time when many firms are doing large rolls. For example, the JP Morgan has been rolling a collar, and that is against their entire hedge fund or one of their large hedge funds that they manage. And so it's been rolled out at the end of each quarter. As the fund changes, it's the hedge for the fund. And so as the assets change in that fund, so do where they're going to place the stops and what the size is going to be. In any case, it was well anticipated to occur, and it did on Friday, but in the process added a lot of volatility in terms of what was happening within the gamma readings, what was happening in the delta readings, because as things got rolled out, things got left off. And so for the expiration itself, which took place on Friday, for that expiration after rolling out, gamma and many other factors really started to evaporate, which produced a different play to be put into place to hedge. So all in all, the markets were very strong pretty much all last week. At least from Tuesday to Friday, they were extremely strong, and in one direction, it was straight up. Now, what that did to the Elliott picture is not necessarily bring about some tall changes like we've slipped and now we're back into an uptrend versus a downtrend. I still believe that the trend remains down, and that began on January of 2022. So the trend remains down. We remain in a corrective posture or a corrective move on a very large scale. So, and by my calculations, we are in a supercycle fourth wave correction, and that is what began on January 2nd, 2022, when the market topped. So I believe we still have quite a bit of downside to do, but it comes in portions, or in like building blocks, I should say. And right now, I'm counting, there was the ABC, an X, and another ABC, and I've been looking for the completion of a primary A. So these are all intermediate degree. Next, we have that. So again, coming down from that top, so you get an idea of what I'm talking about. The top layer is a supercycle wave 3 that completed. So all of this is the beginning of a supercycle wave 4. Within it will be an ABC of cycle degree. Within that cycle degree A wave, there will be an ABC of primary degree. And within that cycle or primary degree A wave, there'll be an ABC of intermediate degree. So now we can begin to count this thing down and see where we are. Initially, I had been counting the entire, all of this remained within a primary A, and I had ABC X, but I'd marked this as A. And then this, or what we were trying to finish, was likely an intermediate B wave. As it turns out, with just what was happening and what happened in between here, it is more likely that an alternate count that I've always had stepped forward. So that's what I'm going to present here. The scale is now tilting a little bit stronger, that at least likely for the balance of April, and we've only just started. But I would say at least the first couple of weeks, maybe even the entire month, and maybe even a little bit longer, depends on how the market unfolds and how quick it does all of this. So if we have completed, as I'm showing now, the October lows would be the completion point for the primary wave A. And previously, like the preferred count that I have been using, would suggest that we've not reached that low and that we were still needing to do an intermediate wave C down to complete this primary A. So that's been shifted to the left and now complete at the October lows, which makes the correction that we've been in, we had an ABC that is wave A. So if it's a primary B wave, What's going to be inside of that primary B wave are an A, B, C of intermediate degree. When we bring it back down, what's going to be in that intermediate wave A? An A, B, C of minor degree. What's going to be in that wave B? An A, B, C of minor degree. So now we have the intermediate A and the intermediate B complete within this B wave counter trend rally. We've always been in the counter trend rally, but now because of Friday's activity or last week's activity, it is more indicative that there is still more to come. It was very strong, regardless of the reason. Because if you remember what I've been talking about last week a couple of times is that Elliott Wave does not pretend that it understands anything about fundamentals, or for that matter, what's going to cause a particular move. What we're registering here and what we're building on are the emotional reactions to a market, what the market is doing. And remember, the patterns are, either you hate what's going on and they don't like it and everybody's got to move out, or they love it and everybody's going to move in. So we've got that momentum going, and that's what produces these. And then again, when we complete the patterns, they're very recognizable in terms of impulse waves or corrective waves. And that's how we build this whole picture. So again, there's human emotional reactions within the market that produce the waves. And fundamental, basically, it's how it's interpreted, how those fundamental whatever are interpreted, how what happens geopolitically is interpreted, how it's going to affect a market, how it's going to affect actually the profits or the loss of the companies. How are their products? How are we as a country going to survive economically? So this continues to roll around those fundamentals, absolutely. But even that's changed in how it's all traded and how we're treating that information and how we're dealing with it. So right now, we still remain in a period where we're in a banking crisis. But what happens? Well, we get stopped because we've got to go into the end of the quarter. So we've got that going on. But they've got to see the financial media can't just say, well, stock's going up because, hey, more buyers and sellers. Well, why? Well, because there's an expiration and they've got to readjust their portfolios for the end of the first quarter, which essentially is what happened. But add to that now we got to go, well, what's the Fed doing? Well, the Fed's sending the governors out and they're saying that the banking system, banks are solvent, banks are solid, quote unquote. This is one of the governors we're talking last week. And so to put a little security underneath us, like, hey, don't worry, we're on the ball here, we're dealing. And whether or not they are, that gets now factored in what people are thinking. Oh, the Fed's got this in control. The banking system is safe. Let me put my money back in the market. Let me go build up my position, or whatever the situation might be. That's what they talk about. And part of that is true because they shifted money coming in. From what I understand, there's particular periods in the market that, say, for example, I think it was a week ago or so, we saw some large sellers in the tech. So Apple, all the big boys in tech got sold off a little bit at the beginning of last week, actually, from the end of last week until the beginning of this past week. We saw the tech. Then comes the week of, okay, we're going into the 31st, and everybody's all on tech. So a lot of, or I don't know how many, but there were CTAs that were wrong-footed, made a mad dash, plus everybody else is going to move in and make their position adjustments. So the next thing you know, it turns into these big rallies. Add into that the role of the JP Morgan collar, which is hedging their big funds, hedge funds. And so now we've got additional pressure one way or the other in the market because they have to roll it out. And they don't make an announcement. You just kind of look for it and suddenly you see the volume, but you'll never see it reported as a block trade. So it's very stealthily done and very well done, I have to add, as a trader. That JP Morgan trader or that group of traders that are putting this on and roll it constantly, they're really very good at what they do. So, and they get it done, regardless of what it actually does to the market. So again, what now changes is the fact that this primary B wave does have more to go. So getting back to it, dropping down to the daily, we're in the SPX. What we have is that primary A wave at the October lows. What we're looking for is an ABC on intermediate degree. There's the A, there's the B. We're inside the C wave. Now we're going to start talking about this incredible rally and start to try to build a picture on underneath that. Now, initially, it did not start out well. This wave one was kind of what some people are calling diagonal. There's some people calling it triangle fashion. It was a diagonal, but it necessarily was not necessarily a solid triangle, because it wasn't. It was just a diagonal, straight kind of very strongly higher and not clean internally. But I am labeling it as minor wave one. Again, we're looking for an intermediate C wave up. All C waves are 5 waves, a number of them in and of themselves. So we have minor wave one, right? Intermediate, we're looking for 5 waves of minor degree. There's 1, there's 2, we're inside the third. And again, I want to just reference that in Elliott, and I talk about it to the downside, it's the same thing to the upside. Inside of a third wave, it's the longest and the strongest. It's the most powerful part of a 5-wave structure. So when we drop into it, and then inside that third, I'm going to come down to the hourly so I can just show you inside the third, we have 1, we have 2, then we have minute 1 and 2. So we're in minute 3 of minor 3. So then we have the extra oomph, the extra power. So that's what I talk about. Well, here it is in motion. This time it's to the upside. We have seen it to the downside. Now we see it to the upside, including a beautiful gap between Tuesday and Wednesday here in the market, where they just walked in, boom, took it from that opening and kept going. Did it again. Thursday to Friday, boom, just opens up, we go, and then we continue to fly. So where are we with inside of this basis, the SPX? We're inside that third. I can't declare it to be complete yet. We may see still some additional, but there would still, in my opinion, once this minute wave 3 is over, we get a minute wave 4, followed by another minute 5 to complete the minor third. Then we get a minor 4th and yet a minor 5 up again. So that's what I'm talking about. And I believe this is now going to take us another week, another 2 weeks, possibly a little bit more. So let's put the first, if indeed this count, I'm going to back out to the 4 again. We're looking for a C wave that consists of 5 waves of minor degree. We've got 1 and 2. We're in the third. So let's start putting what we think that C wave, first of all, right? We're in the C wave, what we believe that can do. We're going to use extensions, and we're going to start there and go up to here to the top of, A wave down to the bottom of the B wave. And now we have for wave C. Now, the C wave would be equal to wave A, which is pretty common, at 45.12. We'll call it 45.15. So, you could even say 45.10 to 45.20 if you want, but that's where the 100% is. Wave C, that actually fits and it works. But let me give you the first one. Now, this one may come up, but it's going to be hard pressed because we've got to see the 5 for the C wave. We had to see 5, and now we're in 1 and 2, and we're still in the third. But wave C can be 0.618 of wave A, and that comes in at 42.43. So we have good, strong resistance from 42.43 up to and including 45.12. If a strong push within the C wave were to materialize and actually come in, we now want to add, this would be for that C wave. So if we're in that third wave, I want to add one more layer, and I'm going to go back down to the hourly chart to do it for this upside. So now we're inside the third, but now I can go from here to here and just do for the minor third. And so minor 3 would be equal to minor 1 at 41.40, 41.40. What's more likely is we can start thinking we're going to get up to 1.236, 1.382. So we're looking at 41.94, 42.28 to 42.30 to complete minute 3. Right? So minute 3, actually, excuse me, to complete minor 3. I was one step too quick. To complete minor 3, we might get up into these levels. more likely we have 42.62. That is where minor 3 would be 1.618 times the length of 1. Again, we're inside of a third wave. We're inside of a minor third. And then on top of that, we're inside of a minute third. Let me add one more layer. So it's going to get a little bit full of resistance, but we're going to start to look for where we might find. So this one's going to be much different because it's going to be pretty clear. We've already reached. So in other words, we're now looking for what are the capabilities of this minute wave 3. We've reached them. The 4106 level, and we're up and closed at 4109. That is 1.618, where wave 3 is 1.618 times wave 1. So that's already met some upside. So if this minute wave 3 is complete, I'm looking for a little bit of a pullback. And that pullback, then we would be able to put fib retracements here. So I'm building your picture. This is your intraday picture now. If you trade this cash market and you want to find out what the capabilities are for Monday, when we start to trade and we start to turn lower, you run retracements, Fibonacci retracements. From there, the bottom of wave 2 to the top of wave 3. And now you've got that. Don't forget, that's just minute 4. Then you still have a 5. Now, can minute 3 continue? Sure can. We have another double up here at the 100% level, where the minor third will be equal to the minor 1, and that comes where the minute 3 would be 200% of minute 1, and that's 4140. Now let's go and see where we have any additional. We have additional, and I'm thinking that the minute 3 pretty much might get up to 4130, 4140, and then we'll get that pullback. That fits and also fits for the minor 3. So we have a couple of marks right there that could get it there, complete that. We still get that fourth wave pullback, and then another rally begins. So, and here again, 1, 2, 3, 4, 5 to complete the third, right? 5 waves. So that could be where we are. We complete minute wave 3, do a minute 4, minute 5, brings us up into here, maybe a little higher. And we complete the minor 3, we get a minor 4, and then a minor 5. So now I got to start backing all this out again. So we looked at that, we're looking at this. And back it out one more. Now, where this is the C wave, where can this whole thing end up? If wave C is going to be equal to wave A, and we're looking at 4512, and I'm going to take it out to the 4-hour, which should show us all of that, right? Here we have the B, and the C wave would be equal, the C wave would be equal to the A wave at 4512. We have a lot in between. So what's going to really matter here is that we monitor that C wave, 1, 2, get the third, get the 4, and then get the 5. And we're going to then get additional overlap up into this territory, all the way up to here. And then we'll be able to track and put a potential top for the intermediate C wave, and in turn, the primary B wave. Now, why I am continuing to look for a rally, remember, as I was talking before, like last week, I said, no matter what drives the market higher, or if it's going to be an extended B wave, or it's going to be a primary B wave, the outcome of either, whether it stopped here or whether it stops here, are the same. The next wave down should be fairly destructive, quick, and just be news driven. Something is going to come up and just sour everything that's going on, and show that what kind of got put to the sideline, banking crisis, interest rates, movement by the Fed, many things, they're going to come from front and center. They've been put to the side. And in fact, as we try to move higher, financial media comes out and tells you about all the reasons why. They pull in everybody to support an upside picture. We can support an upside picture, but I'm not going to rely on fundamentals to support it because the fundamentals, in my opinion, are not there. The Fed, in my opinion, is not going to ease. They're not going to go back to a quantitative easing posture. That would be deadly. That would be deadly for the U.S. economy. And it's just too many things. It would be deadly. Because there's a lot of things that are in trouble. But if we pay attention to what's happening in front of us, we can trade this. This is all very, very tradable. And I'm trying to give a little bit of a bigger picture because if you are a swing trader or a position trader, you can start to position yourself for things, but you're going to want to look for a move to the short side via something that's going to be from up here. So, yeah, it's a while. You gotta kind of hang in there, and there's no reason to stand aside. Unless your position is big enough, then you can put a hedge or a collar similar to what these big firms are doing. They have short positions. That's what they're putting a collar on. And they're rolling that because it's a fund. It's a hedge fund that they're working. So again, that's their position. Ours, if you're a swing trader, I'm trying to give a little bit bigger picture. We do have upside potential. But anytime you're going to put any position on that you're going to leave on overnight, please have a stop, have a target, put all of that information into the market, leave it out there. It's okay. If you're making money or if you're stopped and then you want to say that, well, they got all these stop runs, they do. But if you're in the position where you need to control your a losing position before it wipes out your account, then you're going to use a stop. And if you don't, you're not going to be trading. So the logic there is that you trade according to what your account size is, what your goals are, and how you intend to meet those goals. So you have to have the trading rules, and the trading rules are going to be like you have a trigger or a point where you are going to enter a trade, long or short. Then you have a target or a goal for the trade. And then most importantly, you have a stop where the trade becomes invalidated for the reason you put it on. So if a market were to come down and hit one of my stops, it would be because whatever I put it on to do is not going to happen right now. Doesn't mean it won't happen. Who knows? In 10 minutes, in 15 minutes, an hour, a day, 2 days, we may still get the same position. It's just that right now it's not going to work. If you've got a large account, you might be able to sit it out or trade with it. But if you don't, then you have to be a little bit different about how you want to enter positions. All right, that's the SPX. Let's go over and take a look at the NDX. The NDX is basically in the same type of a position in terms of here we have the cash market. We had an X wave, we had an ABC, boom, October low. Where are you? Here's my primary. Let me bring that guy all the way up. No, hold on. Activate it and bring it up out of the basement here. And let's put this guy over here. So we have at the October lows, primary wave A. Okay, so starting here on the 4-hour chart, the X, primary wave A, and then we have an A and a B, and now we're in the C wave up. So again, that is the October lows of 2022, primary wave A. The December lows of 2022, intermediate wave B within the primary B wave. And that actually can go higher so you can see it's not actually as close as you think. So now, same deal, 1, 2, 3, 4, 5 to form minor wave 1. Then we have this little bit of a complex ABCX, ABC for minor wave 2. So here again, we're in a minor third wave moving higher in the NDX. So what is the potential for this minor third wave? We again use the Fibonacci extensions, and we're going to go from the bottom of wave 1 to the top of wave 1 down to, oops, that didn't work, excuse me. I'm a perfectionist, and I want to see it should anchor it. There you go. Okay, so minor wave 3, the longest, the strongest out of waves 1, 3, and 5. We're in a C wave. That third wave still carries that same pattern, that same characteristic, longest and the strongest. So we can see that wave 3 would be equal to wave 1 at 13,905. So here again, within the Nasdaq, we have some additional upside to do. Now, prior, folks, I know because I trade the Nasdaq and I worked it, and I kept to account that I said, I'm not looking for a move that high. And that's actually true. I wasn't, because if I got it, I have to shift over and bring my alternate count. Now, I've gotten a lot of mixed messages from subscribers who say, you're flipping back and forth, you're flipping back and forth. Which one is it? It's like, market tells me. I don't make it up. I'm not saying with the G market, you've got to follow what I'm saying. It's what I believe the market is telling us. And so the primary A coming in now is because of this rally. And we broke above this level, which changed the count. So I had to pull it over. It's always been there. I've had it. I just don't display it because I put these in by hand, but I have it. So again, primary A, we're in the primary B wave. So now we have intermediate A, intermediate B. We're in the intermediate C wave. So we're still doing exactly the same as the SPX, but it's the Nasdaq. And within that C wave, we've got minor wave 1 and 2 complete, nicely tagged out, ABCX, ABC for 2, and now we're looking for minor wave 3. The entire minor third should come in up here. I believe we may be in minute 5 of minor 3, excuse me. So the only other count that I could have that could keep it going a little bit longer is that we put the 3 up here and the 4 is yet to come. And that could be. So in this case, I need to just see how this is all going to trade, because the Nasdaq put in some wild and woolly stuff. Let me go down to the hourly. We could take a look inside here. This does seem like it could be complete, but again, it could be with the internal, because I could have 1, 2, 3, 4, 5 of 3, which is what I did. And then you get a 4. And then what do we get here? We got a gap. So is it 1, 2, 1, 2, 3? So again, it could be wave 3 of this minute 4. And then we get another little 4, and then we get that 5. Now, can that 5 then get up to 39.05? I don't know, which is why I'm thinking that this is going to have to come over here. Not sure how. But I do believe that in terms of the minor third equaling the minor 1, 39.05. So with that in mind, come on, let me go back out here to the 4 hour, back to the 1 hour. And now I just want to take a look at where we think that the 5th can come in. And that's going to show up way down here. So we're going to come in here, to here, to here. So what do we got? 35.41. Still pretty far away from that 39. But we do have some additional. We do have wave 5 would be 100% at 13,541. And again, depending on how and where this pulls in, we get a little drop. We still can get up into this area. And actually, wave 5 could come in at 1.382 or 1.236 of wave 3, because wave 3 is not the shortest, right? So wave 5 can be the longest in this minute count. So again, can we get up there? Yes. We can get up into there, and it could be just one more quick blast. that gets us up there. Then we finish just the minor wave 3. So let me pull this back out again. And once I have that, right, we get that 3 all done, then we get another 4, and then we still have a wave 5. So I'm going to take this off and take this off, because now I want to look at what the potential for wave C is in and of itself. And I'll tell you why I didn't put that up there. When you come over here and you look at this, that was an extreme, big extreme. So that just to me is the orthodox high. That's why I did it that way. So B, here we have, where can this all end up? Well, we have, again, where wave 3, we're looking at 13,900. Well, we're already up into the stratosphere in terms of where this whole C wave can end up. So it looks like wave 5 may end up being the longest wave, and wave 3 may equal it, come back down, and shoot back up to complete a wave 5. So let's go back and now add one more. We're just going to continue to layer so we can build our picture about where all of these things can end up. Here again, the 1.618, where's that? 13,400 to 13,552. Then we get up into 13,008 or 13,900, 14,048. And that could be where we get the 3, the 4, and the 5. So I would expect that we're going to kind of keep going. And now you have outside of this a lot of numbers a little bit higher. So I'm not really, again, still thinking that, yeah, we may pop above that X wave, which is okay because it's a primary B wave. But primary B now, let me just start taking this off again. Let's take this one off, because now we want to just go, what are the limitations for a primary B wave? So if that's primary A, we're going to go back out to this guy, and we're going to go here. So I can find that sort of. Oh, I didn't want that one. Sorry. I want to just do straight. Yeah, there we go. Come on, take it there. And down to the bottom. So 618, 4,274. So that's kind of where B, but this was all 3 waves. So like in the SPX, we do have the potential where we go into a new high. At this stage, I don't necessarily see it. But hey, who thought the catalyst for this couldn't happen again and again? And it could. So these are the technical numbers. 13,542, 14,274, 14,814. And then we're breaking 15,000. And I'm sure you're going to talk to people who probably have numbers there. But that would be for the primary B wave. And then we really do. So I was expecting a primary B wave, but I thought it would start from a lower level and still carry that same potential. But I thought it would start from a lower level. Does not suggest in any way that I'm no longer looking for these lower levels. I am, but they're being put out. They're yet to come. Right now, we're trading to the upside. If you're a day trader, lots of trading yet to come. Not going to be any clear signs. We're going to be a little bit like, well, the market should go down. It's like it may not. So why? You got to trade accordingly. All right. So this is getting a little bit long in the tooth. So let's get quickly over to the bond market, which also is going through its gyrations and trying to make clear as to what it is intending to do. So what I have going on, I'm going to start from the daily chart, actually, because that still has the same count. We still have the same count where we did an intermediate A wave down off of the all-time highs in bond prices. which was in 2020. And we reached that 5 waves down at the low in October. So if both the equity markets and the bond markets basically bottomed in October of 2022, then they're likely still both putting in varying degrees, but B wave, counter trend rallies. And that is what the bond market is doing as well. I'm considering it a primary degree, but it may be larger. An intermediate degree. It may be larger, such as a primary degree. Within that, we've got the A wave. So within that intermediate B, you have a minor A, B, and we should be in a C wave. Again, within that A wave, we had 5 up. That tells me it should be a zigzag. So we have within the B wave, A, B, C. There it is, nice and clean. So we'd be looking to see where can this C wave take us. So we already have the larger B wave, and that projects 133.11, which we've already been above, but it seems to stall out right there. You can see it. And then we have 142.27. That's just 382. B waves can get up here. But when I said those numbers, people would think I'm definitely way out into left field, considering the Fed's intending to raise rates for a while longer. That would not make the market go up to here or even here or just basically get much past here. But here we go. We just might do it. So that's the daily look. So I've got this minor C wave, which will consist of 5 waves of minute degree. I'm going to go down to the 4-hour chart and open this up a little bit here. Here we have the A, the B, we're in the 1 of 5 up, or a C wave up. Nice. And then we get a first irregular. Then I'm expecting it to, so we're in a minute wave 2 correction. And I'm thinking, we should have gotten above 133 and kept going. We stopped and we nosedived. So what do we get? Boy, another one, right? So first we get the ABC, and that produced an irregular. Then we get an ABC, which is telling me we've got a double ABC going. And now we do the A wave, and I'm going to open this up a little bit. All right, A down, A, B, C up, and then tell me A, B, and it just exploded finally on Friday. But we have resistance all the way up. And I can start putting that in. Again, that's going to be these to start. And here we have 131.07, and it got up. It got through it to 16. Our next level is 131.24. Can it stop there? Yes. And if it does, and it's finished putting in this small C wave to put in, that's the second A. The second B, we'd be looking for the second C, which would be down. This is the A. If this is the B, I'm looking for the C. What is the potential for that C wave? Well, I can't say for certainty because I can't use the fib tool because I'm not sure if the wave B is done. But let's say that it is. Then what I'm going to be looking for is the downside. I'm going to use the extensions using the same wave movement there, and I'm going to come in here. So we'd be looking for 5 waves down, 127. So we're looking for an A, a B, and a C. That's our second ABC. We put a 2, and then the bond market would be expected to rally yet again back above 133, back above 134, and out towards, guess what? We have this first one, and then we have at 133, we have additional resistance just via the wave pattern up to 135, and then we should break. We should break and start heading towards that 142. Now, is that going to be possible? Well, I don't know. We have to wait and we have to see. But right now, if that is finished, and we use those just in terms of just the fibs, right? From there to there. Those are just the fibs, but they're for this internal move. So again, 117 was the high. We have 1 131.24, 132.02. A break above that sends this into a little bit of jeopardy, because then I'm wondering, well, what the heck is it? But I will figure it out. The market will make it clear for me. But we still, I believe, in my opinion, need to finish this larger C wave, part of the counter trend intermediate B wave. I think it still needs to be completed. So I do believe there's still upside in bond price, which would mean yields go lower a little bit. I do not believe the Fed's going to ease, but they may jump in and do something, but I do not believe they're going to start lowering the rates. Inflation's not dead. Inflation is not going away anytime soon. So there's that. And that would be, this is the 30-year bond. Eventually, I am looking for it to finish the move. But first, before we get there, I am thinking, first we got to finish this little internal. If it is done, then we start to go back down again. And here's our support coming off. 127.14 would be where the C wave would be equal to the A wave. Very common, very clean, get down there. Not too much damage to the overall. Advance thus far. We put in a wave 2, and then we go. By the way, the 30-year bond, the interest rate closed on March the 31st was 3.67. So we're still hanging out in this area where, like, which direction should we go? Are we going to go higher, or are we going lower? Lower would suggest that we push up towards 3.5. 3.60, 3.5, up in there. We've been there before. We'll probably see it again. Now, over in the 10-year note, pretty much the same story. Market is back at that 3.5 lever after drifting last week all the way down to 3.39, week before 3.70, week before that 4.08. So we had a 50 basis point, actually almost a 60, almost 70 basis point move for under 2 weeks. And now we almost tack back on 10 basis points back higher. So again, I think that here as well, we have, but this is a little bit different. We have counting the C wave, a 1, 2, 3, 4, and then this is where I get stuck. The 10-year, it's like, what are you doing 10-year? So I got to let this play out a little bit. So, but here, as with the others, we have still we should get another move above 117. And if I had to go from this still could work. 1, 2, if we rally, we're in. What I'd be looking for is something, and this is kind of a rough estimate, but we have 117.035, 117.181, 117.305, and then, boy, then it gaps a little bit there. Then we have 119.025. That is out there, along with 120.260. Those are the levels to finish the C wave. 119.025, 120 would be next up after all that. And that would be, but we need to turn around, hightail it up. This is like, wow. It doesn't fit as cleanly as the 30. The 30 didn't go and break to a new high over that. So it's still within what we would call a wave 2. This is a little bit different. So either I'm going to have to move this, which I may do, and then but this is what kind of gets me, the new high. But we'll see. But in any case, those are the numbers that I am working with for the 10-year. Downside, I think that we're going to use the same. So let me get rid of those. If we still have another leg down to do, or again, if this is all finished, this is the part, it's like we're at these levels where we're just not. Those are the ones I want. I'm starting here. Come on. There. 2, there to there. Again, if these are correct, this is a 4-hour chart. Let me go down to the hourly so we can actually see it. Okay. Yep, those all work. So I would be looking for, that's an A, B, and a C. C would equal 6.618 of A at 113, 115. 100% at 112.095. Still not doing a whole lot of damage to the rally, even though this is all weird. So if those hold, then we're still going to have to consider that the 10-year still has also upside. A little bit different story, a little bit more complex, but that's the bond market doing basically the same thing as equities, presenting a very confusing picture. The 5-year, we got the same story here as well, that we're coming up. We had these lows all equal, so it's very strange. It's difficult. Then we had a little strong rally last week. So again, and again here, we pushed a new high, so it makes it a little bit more difficult to actually get a grip on what the 5-year note is going to be doing. So that's why it's all left open. But on a C wave, maybe that was it. And we get the short end of the curve starting again to widen with the yield curve. If not, then we stop. We either are done with the pullback and we start to rally again. And here are our points. And essentially the 5-year can get up to here. That's a pretty big move. But yields would be pretty low if they got up there. This was that massive rally a week ago. Then we just gave it all back. And now they're starting to move it up again. So we're going to go by the bond market. They can go in either direction and it would be trackable and you can get levels. Lastly, we have the 2-year note, which is also just as confusing. But if this holds, if that holds, then I'm looking for this to be a 1 and that to be a 2. And then we start to rally again. Here as well, 382, 104, 0.50, 105. So we're at 103. 2 more points, it would be pretty dramatic, but it can do it. And the 2-year's been very volatile. Look at that. It went up, it got above 104, and it just nosedived. Steady, 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 just down. And then finally, at the end of last week, starts to turn higher again. Will it last or will it turn again? So a couple of scenarios you got, is it all over or is there more upside? So take a look at gold, which actually gold fully understands that something's up. Gold at the moment has become turning back into safe haven status. So what I'm seeing here in gold is that we have a first wave and a second wave. If this is a wave, a fourth wave here, then this is all going to be part of a larger 1, 2, 3, 4, 5 to finish a 5th wave up. So within it, we've got waves 1 and 2 complete, and we picked up in a 3rd. And this again is what a 3rd wave should look like. Now, bringing it down to the hourly chart real quickly, I'm labeling. I had a, oh, there it is. Let me just get that, bring that up so we can see what it is. It is a first wave. So that beautiful rally, wave 1. Again, I don't know, 2 may not be over yet. It's got a little sloppy, but still, we're breaking above 2,000, dropping back, broke above 2,000, dropped back, broke above 2,000, dropped back. So we're still playing around trying to get ourselves back above and stay above 2,000. A lot going on that are affecting it, but what I am seeing and what I'm continuing to see, it is central banks. Central banks are buying gold. So it's, yeah, there's a lot to talk about in gold, but I'm going to reserve that for an update on gold by itself. Right now, I'm looking for the completion of a wave 2. And it's not clear whether that correction would be over or whether it actually has some additional downside to put in. See, because if this is just ABC and it's done, and this is 1 and this is 2, and I don't know what that is. because if the momentum to go up will strike again and we'll just move. But it was very questionable in here as to what comes next. But I do feel that gold is in an uptrend. Right, 1, 2, and we're going to get that's 1, 2, and we're going to see even on my daily, it just doesn't look like that's done. And it looks like it's kind of just putting in a small triangle pattern, actually. And the resolution would likely be one more leg down, and that would be wave 2, and then we rally, 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 rally. The potential here in gold is pretty big. Wave 3, that would be a minute wave 3, would be 100% of minute wave 1 at 2165. No, excuse me. Yeah, 2165, let's call it. We have fibs all the way up to much higher levels. If I go out to my weekly chart, I'd have to go even further. Let me go out to my 20. I could build from here, but I have to go out to 1, 2, so we can get what that primary third should look like. Here we have 3, 4. What is that minor fifth? Minor fifth, I would say that we get up towards that 2300, 2400, up into here. And then we'll finish that up, and then we'll see what happens from there. Silver, the laggard, but I believe is coming on the comeback and should also, as it does, once gold started to break hard, so did silver. And why? Because silver dealers noticing the same thing that I did, that you have central banks buying gold, they're going to buy silver. Silver becomes a safe haven like gold does. And even though it's considered the bastard stepchild to gold, it will react and it should follow in times of what the people or what traders are feeling are bad times ahead. So I think there's one of the messages that the precious metals are telling us, that there's hard times coming. So 1, 2, we could be in the third, and if it is, it should just continue to explode. What can that look like? Well, let's just see. If we're in the third, again, that was an anomaly, and this is this is where the high was. I think these were as well. So we'll just leave it there for now. What we're looking for in the third, longest and the strongest, 1.618. We're looking at silver that has the potential, the possibility of getting up to 3140. That's at 24. So it's already made a very solid 5-cent move. $5 move, excuse me. $5 move. Off of that 20 level, almost $4. So what's up next? Well, we're right at that resistance, and that is 618 resistance of wave 3. I'm looking for it to break there. So I think we break back above 25 and start heading towards 27 as a minimum, where wave 3 would equal wave 1. And then lastly, over in the dollar index, this one also presenting a confusing message, but I still believe it's holding within this labeling. So if we're counting that, we're counting and altogether an intermediate B wave decline. Oh, excuse me, that's A wave. So intermediate B wave decline. And right now we have minor A, but only minute A of this minor B. So I think we still have an A, a B, and a C wave. So the dollar still looks like it should rally, get itself back above 106, complete a C wave before it would ultimately begin to drop pretty precipitously, as we have seen previously. But I still think we have a chance at getting ourselves back up into these levels to complete this minor B and then drop. What's going to perpetuate the drop, of course, would be if we get some fluctuations in the interest rates. If interest rates really do start to climb versus decline, that's going to benefit the dollar. There'll be more dollar buyers to get a hold of that interest rate. So the reasons for it to go in both directions, we're going to have to let the market tell us. Right now, it's not able to really mount too much of anything. It's kind of stuck in a pretty tight range. So we'll wait to see. Downside, I'd be looking for it to hold above this par 82 or just right around that $100, $1 1 for 1 level. So, yeah, if it starts to drop below, it could be spelling something pretty serious, although we have to always consider we might get an irregular B wave even within the dollar. So it comes down, puts in a slight new low below that low, which we saw in February, and then still rallies, rallies, rallies. So again, this could be the bond market finishing its move, and then the bond market moving into the next one, and the dollar just catching a very strong updraft. So both still very realistic. I'm not expecting that dollar collapse just yet. I think eventually, yes, but I think it starts from higher levels and then takes it, and we do go below 100. All right, that's where I'm going to complete it. Thank you all for listening. I will be making an Elliott Wave update tomorrow, and those will just be confined to the futures market in the Nasdaq 100 and the S&P 500. I hope you have a very balanced and great balance of the weekend, and the next update will be tomorrow.